Welcome to our deep dive on retirement strategies for middle-income earners in the 12% federal tax bracket. In this video, we will break down Roth IRAs versus pre-tax plans, the importance of securing your employer match, how the Savers credit can boost your savings, and how to handle high-fee 403(b) plans. We will also show you a practical savings order and an action plan to hit at least 15% of your gross income toward retirement. Let's get started. If you feel behind on retirement, there is still a powerful path forward. When you are in a lower tax bracket today, you can lock in taxes at that lower rate and potentially enjoy tax-free growth for decades. This is especially compelling for those in the 12% bracket. With the right order of contributions and an eye on fees, you can make rapid progress. Here is our roadmap. First, we will explain why the Roth IRA typically wins in the 12% bracket. Next, we will emphasize the employer match as your first priority. We will walk through the strategic savings order and the Savers credit. After that, we will examine 403(b) fee traps and how to audit them. We will also cover when a taxable brokerage can be smarter than a high-fee plan. Finally, we will give you a step-by-step action plan and test your understanding with a couple of quick quizzes. Important disclaimer: this video is for educational purposes only and is not individualized financial, tax, or investment advice. Tax laws and plan options change, and your personal circumstances matter. Please consult a qualified professional before taking action. First, always secure the employer match. The employer match is essentially free money and represents your highest guaranteed return. For example, if your employer matches 50% up to 6% of your salary, your first goal is to contribute at least that 6%. Do this every paycheck so you capture the full match. Only after capturing the match should you move on to the next steps in your savings order. Next, let's explore why Roth contributions often dominate in the 12% bracket. When you pay taxes today at 12% and contribute to a Roth IRA, your money can potentially grow tax-free for decades and be withdrawn tax-free in retirement. If your income or tax rates rise in the future, you will be glad you paid a lower rate now. Unlike many pre-tax accounts, Roth IRAs do not have required minimum distributions during the original owner's lifetime, allowing more flexibility. In addition, Roth contributions compare nicely with the Savers credit if you qualify, further increasing your effective savings rate. Now, here is the strategic order. Step 1. Contribute to your employer plan, such as a 403(b), up to the full match. Step 2. Max out your Roth IRA using broadly diversified, low-cost index funds. Step 3. If you have not yet reached roughly 15% of your gross income going to retirement, return to your 403(b), only if the investment lineup is low-cost and high-quality. Step 4. If the 403(b) is expensive, consider a standard taxable brokerage account with tax-efficient funds. Review annually and adjust as your income, tax bracket, or plan options change. Let's compare. With a Roth IRA, you pay your 12% tax now, potentially enjoy tax-free growth, and avoid required minimum distributions during the original owner's lifetime. This is compelling if you expect higher income or higher tax rates later. With a pre-tax 403(b) or traditional IRA, you get a deduction today, but you will owe taxes in retirement, and you must take required minimum distributions, which raise taxable income. Pre-tax can still be sensible when the plan is low fee, and you expect to be in a significantly lower tax bracket in retirement. The Savers credit is a significant hidden benefit. It is a non-refundable tax credit worth 10 to 50% of your retirement contributions up to a limit, depending on your adjusted gross income and filing status. You claim it using IRS Form 8880. Because this is a credit, it directly reduces your tax bill, effectively increasing the amount you keep. This can stack with Roth benefits, making your savings even more powerful. Always check the latest IRS thresholds as they change over time. This table is illustrative and emphasizes that the Savers credit has 3 primary bands: 50%, 20%, and 10%, based on adjusted gross income and filing status. The exact AGI thresholds adjust annually, so always consult the latest IRS Form 8880 or IRS website for current numbers and eligibility rules. High fees erode returns over decades, especially in some 403(b) plans. Ask HR or the plan provider for the 408(b)(2) fee disclosure and the full investment lineup. Review each fund's expense ratio. Prefer low-cost index options typically under 0.10 to 0.20% when possible. Be cautious with variable annuities and surrender charges. A simple, diversified approach can use a total U.S. stock market, or S&P 500 index, paired with a bond index. If your average costs are above roughly 0.50% and the lineup is poor, consider limiting contributions beyond the match and using a taxable brokerage with tax-efficient funds. This table shows how fees compound against you, starting with $50,000 for 30 years at a 6% gross return, a very low cost of about 0.05% yields, roughly $285,000. At 0.5%, the result falls to around $246,000, a loss of nearly $39,000 compared with the low-fee option. At 1.5%, the final value drops to about $187,000, nearly $98,000 less than the low-fee scenario. These are illustrative. Your actual results will vary. Here is your step-by-step plan. First, calculate 15% of your gross income as your minimum retirement savings target. Second, contribute to your 403(b) up to the full employer match. Third, open and fund a Roth IRA using low-cost index funds. Fourth, verify if you qualify for the Savers Credit and file Form 8880 if you do. If you have not yet reached 15%, add more to your 403(b), only if the plan offers low fees and strong options. Sixth, if the 403(b) is expensive, use a taxable brokerage with tax-efficient funds. Finally, automate contributions, rebalance annually, and review fees at least once per year. A taxable brokerage can be the smarter choice if your 403(b) is expensive. If your taxable income places you within the 0% long-term capital gains band, you may be able to harvest gains and reset your cost basis with little or no federal tax. Use broad market, low turnover index funds to keep annual taxes low. Focus on qualified dividends and minimal trading. Coordinate contributions to maintain adjusted gross income within favorable thresholds. Always verify your exact income limits each year, as the 0% capital gains band is subject to change. This timeline illustrates a practical 5-year ramp for a late starter. In year 1, capture the full employer match and open a Roth IRA. In year 2, focus on maxing the Roth and auditing your 403(b) fees. By year 3, target at least 15% of gross income, using a taxable brokerage if the 403(b) is too expensive. In year 4, if your income allows, consider tax gain harvesting within the 0% long-term capital gains band while maintaining your Roth maximum. In year 5, rebalance, review fees again, and increase your savings rate with any salary increases. Repeat this cycle annually. Here is a concise cheat sheet using Markdown formatting. It restates the core rules. Secure the employer match first. Recognize that the Roth IRA typically wins in the 12% bracket. Follow the strategic savings order. Choose investments with low expense ratios. Target at least 15% savings. And check your eligibility for the Savers Credit. Quiz time. The question is, what is the generally optimal contribution order for a 12% bracket earner? Option A, max Roth IRA, then 403(b), match, then taxable, then back to 403(b). Option B, 403(b), match, then max Roth IRA, then back to a low-fee 403(b), and taxable only if the 403(b) is expensive. Option C, taxable first, then Roth, then 403(b), match. Option D, only pre-tax 403(b) until retirement. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 403(b), match, then max Roth IRA, then back to a low-fee 403(b), and taxable if the 403(b) is expensive. This sequence captures the match, leverages the low tax rate via Roth, and only adds more to the employer plan when the fees are acceptable. If the plan is costly, a taxable brokerage with tax-efficient funds can be a better alternative. Second quiz. The question is, when might a taxable brokerage be preferable to contributing beyond the match in a 403(b)? Option A, when the 403(b) offers rock-bottom fees and great index funds. Option B. When the 403(b) has high fees and poor fund choices, and you can invest tax-efficiently in a taxable account, possibly within the 0% long-term capital gains band. Option C. Never. Taxable is always worse. Option D. Only if you already saved 50% of your income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, when the 403(b) has high fees and poor fund choices, and you can invest tax-efficiently in a taxable account, potentially within the 0% long-term capital gains band. High fees can outweigh the tax deferral benefits, especially over decades. These are the key takeaways. Always capture the employer match first. In the 12% bracket, the Roth IRA generally provides superior lifetime tax efficiency. Use low-cost index funds because fees compound against you over long periods. If eligible, take advantage of the Saver's Credit. Aim to save at least 15% of your gross income. If the 403(b) is expensive, a taxable brokerage with tax-efficient funds can be a smart alternative. To wrap up, secure your employer match, then prioritize the Roth IRA, and only add more to your employer plan if the fees are acceptable. Guard against high fees by auditing annually. Use the Saver's Credit if you qualify and manage your income to stay within favorable tax bands. Automate contributions, rebalance, and increase your savings rate as your income grows. Thanks for watching. If this video clarified your retirement path, please like, share, and subscribe. In the comments, tell us your savings order and how you are optimizing fees and taxes. Your insights can help others, and your questions may shape our next episode.